UK inflation figures on Tuesday the 13th, UK wage growth and unemployment numbers on the 14th, and American inflation figures, also on Wednesday the 14th, will be the big macroeconomic features of the week. The higher inflation and wage growth go, the more likely, in general, the Bank of England and the US Federal Reserve are going to want to raise interest rates, even if right now the former's governor, Mark Carney, is playing tortoise to the hair of the latter's chairman, Jay Powell, as we can see here. In fairness to Mr. Carney, the UK economy isn't growing as fast or strongly as that of America, as we can also see here. So, let's see what the latest batch of price figures bring. For the record, last month, UK inflation was 2.4% based on the Consumer Price Index, or CPI, after an unexpected dip lower. UK unemployment was 4% and wage growth was 2.7%, including bonuses. And US inflation was 2.3%, also based on the Consumer Price Index, oddly enough, a 7-month low. In this next graphic, we can see the trend in the British and American inflation rates. That sudden summer dip may give central banks some scope to hold off from further interest rate increases, should they so wish. However, the Fed still seems keen to crack on, although the Bank of England does come across as a bit more reluctant to act, at least until the Brexit negotiations come to some form of conclusion. On the company front, we have a busy week of corporate news ahead of us with 8 FTSE 100 members and a good number of FTSE 250 and small cap firms scheduled to issue results or a trading statement. And they include DCC, Experian and house builder Taylor Wimpey on Tuesday the 13th, Real Estate Investment Trust British Land, Smiths Group and utility SSE, which has already served up a profit warning on the 14th, and Royal Mail on the 15th, and that's another firm that's already confessed that profits would undershoot analysts' forecasts. For all of the interest that little group's going to generate though, for me the stock most capable of causing a fuss in the week ahead is Vodafone, when it releases first half results on Tuesday the 13th of November. The telecoms giant has been a horrible performer over the past 12 months. Its shares have fallen by some 30%, while the FTSE 100 has lost just around 5% over the same time period. The interims will therefore be the first real test of new Chief Executive Nick Reed, who took the helm on the 1st of October when Vittorio Colaio stepped aside after just over 10 years at the top. Vodafone shares have been under the cosh for 3 particular reasons. First, not everyone is convinced that May's €18.4 billion acquisition of Liberty Global's cable networks in Germany and Eastern Europe was the right thing to do. Even if the deal boosted Vodafone's capability to supply mobile, fixed line, broadband and TV services, the so-called quad play in these markets, the purchase added to an already substantial net debt pile, €31.5 billion excluding India and €39.5 billion including India. Second, competition's been hotting up in the Spanish, Italian and British mobile telecom markets, potentially putting pressure on prices, margins and profits in what are 3 of Vodafone's 4 biggest markets. Germany's actually number 1. And thirdly, Vodafone is having to acquire spectrum for 5G, 5th generation mobile services in auctions in most of its major markets, and it'll also at some stage have to invest in 5G kit and capacity. It had to spend £378 million in the UK and €2.4 billion in Italy, more than analysts had expected on both counts, with more auctions to come, including in the Netherlands and Germany. We can see Vodafone's recent annual spectrum spend here. The worry is clearly that cash requirements are going up, interest payments on debt, spectrum auctions and network spending, just as competition and pressure on profits is heating up. Analysts and investors will be looking for a reassurance on 3 issues then when they look at Vodafone's interims. The first is management's guidance. That is for growth in underlying adjusted profits of between 1% and 5% against last year's figure of €14.75 billion based on the metric of EBITDA, or earnings before interest, taxes, depreciation and amortisation. I know, they don't make it easy for you, do they? The second one is to look at management's guidance for free cash flow of at least €5.2 billion before, note, before spectrum costs. And the third thing to look at is the dividend, which is now paid in euros. Vodafone has grown its annual shareholder distribution every year since its flotation in 1998, as we can see in this final chart. Some analysts think this combination of debt plus competitive pressures plus spectrum auctions could put that proud record under threat. Last year, Vodafone made an interim payment of 4.84 cents on its way to a full year dividend of 15.07 cents. Even just a repeat of that would equate to a dividend yield of more than 8%. Now that may tempt some, assuming Vodafone can reassure the payments are safe and not even at risk of a cut, given that earnings cover is actually less than 1 times. Thank you for watching, and I look forward to seeing you next time.